Hey, what's going on, guys? Let me know if you can hear me. If you could drop a comment in the box to basically just let me know that my vocals are getting picked up and we're live with it. Drop a comment. All right, awesome. Thanks, Jameson. So I'm gonna give it a couple minutes and then I'm gonna go into the lessons for today. Today we're really just gonna cover. I'm taking things very slowly. So like I mentioned before, this mentorship is going to be something that's going to live on YouTube completely free, and it is going to be something that does not um that is again is going to be over the course of a few weeks, a few months. It's not going to be something that you're going to get everything you need to know in like a week or two. It's going to be something, a little bit more uh kind of drawn out, a little bit more in depth, and we're going to take our time with it. So today, obviously, the premise of this mentorship is going to be studying forex, like I mentioned last week. So last week, what we did is we obviously talked about the times, the sessions, the different, what is forex, an introductory to that, the sessions, the currencies, right? So everybody should have a little bit of understanding of what forex is if you didn't already, right? So just very basic review stuff. Now, for this week, what we're going to talk about is power of three and how price moves in these individual session times. So we're going to start to dive into a little bit of chart work, a little bit of concept stuff. And so from here on out, the concept, there's going to be a mix of conceptual stuff, but then also a mix of live chart action. So it's going to be a short lesson. I think it should probably be about 30 minutes max, um, for this week, but it's something that again is going to be very crucial to understanding how price moves, right? And so obviously we're here to learn how to trade. In order for us to learn how to trade, we got to understand how price moves. Um, so I'll give it a couple minutes. If you guys have questions from last week, feel free to drop them in the chat while we're waiting, and we'll go from there. And then before we get into it, just kind of want to see. I don't know. There's probably some existing mentorship students on here, but then also some people that are new. If everybody could just kind of just drop, just so I have an idea, like what their proficiency with trading is. If you guys are traders actively trading, or just this is your first time hearing about day trading, just so I kind of have an idea of like who I'm teaching to for the course. Obviously, there's going to be more people that watch this after the fact, but just for the people on the call today. Okay, so active and it's about 3.5 years. Tony says active and it's about 3.5 years for me, starting to happen if I follow the rules and discipline. Okay, so I get what you're saying. Like you start to see a little bit of success. Dusty says she's been trading for about a year. James, and I apologize if I'm pronouncing your name wrong. Some studies, some Elliott basics, TA options. Want to learn more about ICT? Okay, bet. So I'm gonna my style of trading falls more in line with smart money. It's very similar to some ICT concepts, but it's the idea of institutional trading and liquidity based trading. So that's kind of hopefully answer a lot of your questions with that. But so before we really get there, again, the concept that we're going to talk about most today is going to be power of three and how that plays into the individual sessions. So let's start with that. So let's go ahead and get into it. I'm going to share my screen real quick. So last week we had a chance to talk about the three major sessions in Forex. So it sounds like everybody, if you've been trading for more than 6 months, you probably have an understanding of that. But our three major sessions in Forex are going to be the London session, New York session, and then the Asian session. And so what I want to introduce to you guys today is, again, they're going to be the concept of power of three and how that plays out from a daily perspective in the market. So we'll grow our perspective from like a session perspective, then to a daily perspective, and then a long-term perspective to kind of point out some of the things that I do on those calls that you might see me do on the weekends where I am projecting price, right? So a good trader is going to be able to project price not only on a session level, like where they think price is going to go for the session, but then also on the weekly and the daily range as well. So I every day I trade, I do a combination of all those things. And so I want to make sure that we are kind of touching on all those things. So let me share my screen again. Let me see if this works. Because before we hop in the chart work, I want to talk about this conceptual stuff. So let me do this. Present, share screen, window, open, system preferences, Google Chrome. Oh, it's not going to let me do that. Okay, let me try this instead. Having a little bit of technical difficulties. And if you're new to these concepts, I apologize. Or if you're not new to these concepts, I apologize. But I need everybody to kind of get on the same basis uh, as far as concepts. And I think this is going to be the easiest way to have that happen. So do this instead. Since I can't share my screen, I just have to move this over. So bear with me 2 seconds. So let me see if this works. So yeah, so to go back to Winston or Jameson's question, um, when I first started trading, I traded something that I've been exposed to a lot of different styles, traditional technical analysis to a long time ago. There was this guy named Steve Morrow, and he had this program called Beat the Market Maker. And there was a lot of things that I picked up from him that inevitably, this is about 10 years ago, that kind of made the fundamentals to how I traded. It kind of gave me the fundamentals to how to trade. And a lot of it is kind of very similar to what you'll see in smart money concepts or kind of like ICT styles trading. So that there was bits and pieces I took from that. I always give shout outs to people that helped me along the way. So Q Banks is another person that helped me kind of give me a better understanding of like technicals, traditional technical analysis, and then kind of bringing it home again with smart money concepts. So let me see if this works. I'm gonna share now. But I'm just saying that to say that I've had a lot of different mentors along the way and a lot of different people that have kind of given me a lot of different perspectives on the market that kind of make me what I am now. So I always give credit where credit is due, but I don't necessarily have one individual style from them. So thumbs up in the chat if you guys can see this uh, in the chat. Should just say untitled document. I'm showing my screen. So today, what we're going to do is we're going to be talking about what's known as power of three, right? And I'm starting with this concept because I think if you can understand how the market moves and how systematically the market moves on a daily basis, then you can use this to kind of predict and project price for your session. And it starts with being able to predict what you think is going to happen in the day, right? And then kind of growing that from there. And so the most powerful thing, most powerful concept in the market is the understanding of power of three. And so when we talk about power of three, it's really going to be composed of three stages. It's going to be accumulation, manipulation, and distribution. So if you understand this, you understand where the market's going and why it's going to the direction, entries and exits are the easy part, right? And so I think a lot of times traders don't understand what drives the market. It's pricing, what drives the market in terms of like why it's going to certain levels, right? And I think people just think if they throw a fib level on a chart, they'll understand it, or if they throw some type of support and resistance, it'll do that. But if you don't understand the underlying market mechanics as to why the market's moving and how it moves, then you're always going to be trading out of state of fear, and you're never going to really understand really feel comfortable enough to throw huge lots on trades, right? Um, Anytime you see me in the chat throw $3,000 or $5,000 into a trade setup, just know there's a lot of risk on that other end too. And if I'm not confident in what I'm doing, then I would probably blow my account, right? Because wouldn't be able to really pick a side, and I would be trading back and forth. So having a higher time frame idea of what you think the market should do and why it should do it is key, and just having confidence in that. And I think understanding the market mechanics and really breaking this down from a guessing game or a fear game to technical science is key. So we talk about the market. The market really moves in three different patterns. It's either going to move in an accumulation pattern, a manipulation pattern, or a distribution pattern. And we'll pull out a lot of forex examples, kind of just to show you that. And I think when you trade forex, this is going to be so prevalent, so prevalent most of the time because it's gonna actually line up with the individual sessions of the forex day. And so when we talk about the accumulation phase, so the accumulation phase is really the starting point of the market cycle in the power of three strategy. During this phase, large institutional traders and market makers began to build positions in anticipation of future price movements. In the future lessons, we'll talk about liquidity and we'll talk about why the market is moving to certain levels. But as of right now, I just want you guys to understand this concept. If you can start to see this, then it's going to start to make a lot more sense along the way. So, characteristics of the accumulation phase include market quietness, right? Or the trading volume is going to be typically low, and price action may appear to be ranging or moving sideways. You might refer to this as consolidation, right? Market support and resistance levels. Clearing support and resistance levels often emerge during this phase. And then volume analysis. So despite overall low volume, there may be sporadic increases in volume as institutions accumulate positions. For example, in the forex market, you might observe the Euro USD pair trading in a tight range for several days or weeks. During this time, prices repeatedly testing a specific support level or resistance level, but does not break below it. This could indicate accumulation by large players at the support level. Manipulation phase is where the market becomes more volatile and unpredictable. During this phase, large market players tend to move price in a way that triggers retail traders stops and creates liquidity for their larger positions. Again, in future lessons, we'll talk more about liquidity, the idea of the market makers, right? But as of right now, I just want you guys to see the market through this three-step lens. Key characteristics of the market of the manipulation phase include false breakouts. Price may briefly break above or below key levels before quickly reversing. You might hear people refer to them as stop hunts, which will be sharp price movements designed to trigger stop losses of retail traders. And then emotional reactions. A lot of times when you blow your account in these moments, you are kind of you're getting experiencing the kind of the negative end of manipulation in the market. And retail traders often make the impulsive decisions based on these volatile movements. So for example, continue with that Euro USD scenario. If you're at accumulation support, you might see a sudden drop below the support level, which could really, trigger the stops of traders who went long at support. However, then price quickly reverses and moves higher, and it leaves many traders stopped out of basically potential positions. The last phase is really distribution, and so this is going to be again where the large players who have accumulated positions begin to sell or buy back stops in the newly created trend. Just some quick characteristics is going to be this is going to be the trend. So when you talk about distribution, it's going to be the actual trend that you see that plays for hours and hours. You're going to see increased volatility and then volume confirmation, right? So, if you're using indicators that have volume, I don't personally trade with any indicators, but a lot of the indicators you'll see that measure volume, they will typically be very active during that run. Um, so when we look at this on a daily basis, you might see something like this: accumulation, manipulation, and then distribution, right? And so when we understand this concept, we can take it to uh, we understand that this is really generally how the market moves in any scenario. This is how it moves. Every individual candle moves, how every uh, day moves in the markets. We have price create a consolidation point. It forms a low and then forms a high, right? And so as we go back to the charts, I want to bring you guys to a couple examples here just to get this idea of what this looks like in the actual real markets, and how this lines up with kind of like what we talked about last week with the power, I'm sorry, with the different session times. um so let me remove this and then hop over to trading view. So I'm assuming everybody's familiar with trading view. I'm going to pull up your normal Euro USD chart. This is the chart that everybody should be familiar with. Give me 1 second. Cool. Awesome. Just give me 1 second, guys. Share this over. Present. Share screen. Euro USD. So I'm just going to speed this up a little bit. This is an example that I want to show you guys. And so if we remember the three sessions that we talked about last week, right? The cool thing, and one of the reasons why I think Forex is actually the easiest market to trade over indices, is because everything typically revolves around power of three, and that specific power of three is tied to each individual market session. So when we talk about sessions, We talked about three things, right? We talked about the idea of consolidation, manipulation, and distribution, right? So when we talk about consolidation, this is going to be most tied with our Asian session. And the thing about trading is that not a lot of people look at, I mean, a lot of people do look at the market through this lens, but most traditional retail concepts do not look at the market through this lens. And I can go to like a very, very detailed breakdown as to why these things happen during this time, but I don't think it's going to make you guys trade better. So I'm going to spare you. But when we think about consolidation, this is going to be our Asian session range in Forex most of the time. What's going on during Asian session is that the market is accumulating contracts. These big banks, these big hedge funds, these big institutions are creating contracts and liquidity in the market by placing orders in the market. And as a result, the market's not moving, right? Um, and it's kind of preparing for the day. So if you had to look at the 24-hour cycle of Forex, Asian session is most likely going to be the session where you're strategically planning, right? Like big banks, big institutions, they're not putting or they're not the market's not moving yet. It's kind of like the planning session. Like your first couple hours a day at work, you kind of figure out what's going on for the day. Um, our Asian session range is going to be about 8 p.m. Eastern Standard Time. If you're trading with me, then you need to have your time on New York time, UTC 4. So again, our Asian session range is going to be ranging from about 8 p.m. to 1 a.m. Now, the actual times that you're given in Forex are actually a little bit different than that. But for all intents and purposes, these are the windows of time that I want you guys to look through. So our Asian session window is going to be about 8 p.m. The previous day until 1 a.m. on the current day. In this case, this example is coming from Tuesday, October 8th. So this was last week. And what's going on in this time frame is for the most part, the market is consolidating, it's ranging back and forth, right? There's not really a clear direction in this range. I'm going to draw from here to here. You can see there's not really a huge momentum going on right now. At the beginning of our manipulation phase, and just to go back to the drawing, the market will start to make a high, right, for the beginning of the session, at a beginning of London session. So our London session window is going to be, the London session window ranges from 3:30 a.m. to noon. But what the window that I want you guys to look through for this, the context of this lesson is going to be 2 to 5 a.m. This is most likely is where most of the majority of the action is going to happen at. That's going to kickstart the session off. So from 2 to 5 a.m., this is going to be known as our London session window. Let me draw this, oops, line here. 2 to 5 a.m. I'm going to clone this. Sorry, I wrote London when I meant Asian. Sorry. This is really where the majority of our manipulation is going to occur. And what I mean by manipulation is you're going to hear it referred to as manipulation or a false move against the trend, right? So I'm just going to draw this on here. Our distribution phase on the daily is going to consist of the actual trend that we see, right? And so we think about the trend that happens for the day. This is going to be our distribution phase. This is going to happen pretty much from whatever the high of the day or the low of the day is, and I guess in the opposite example, throughout the rest of the day. This is going to be the trend that you're most likely trying to capture. So if I had to back you up and say, let me get to the end of the day. Draw a line. Noon. Asian session, London session, New York session. So if I had to guess, like if I had to uh, give you guys a uh, a choice as to far as what you were going to trade, right? There's three options here. You could trade this consolidation that's going back and forth in this range from here to here. You could trade this up move right here, or this trend right here. Which is the trend that you would rather be a part of, right? It's not a rhetorical, or it's not a trick question, right? Would you rather trade this consolidation back and forth? Would you rather trade this up move here where the market's going higher? Or would you rather trade, again, this distribute or this final phase here where the market's moving at least, looks like at least 30, almost 40 pips in a day, in a session. So which one would you rather trade? I'll wait. I got a couple seconds. Okay, so Jensen says it would be nice to catch most of the US session down. So cool. So the trend starts in London, right? But you're right. I would rather catch the majority of this down. And so that's exactly what distribution is, right? So the majority of the distribution is what we try to capture as traders. And that's going to happen. It's going to usually kick off in London session and continue in the New York session. So if you can start to look at the market through this lens, especially if you're trading Forex, if you can start to look at the market through this lens of Asian session, London session, and New York session, really being kind of like the Kickstarter parts of the power of three, where Asian is going to be the consolidation phase, London session is going to be the start of manipulation, and I'm sorry, the manipulation phase and the start of distribution, and New York is going to be the rest of distribution. Then you can start to kind of frame out what the actual Forex day looks like. So this is going to be the basis to how we trade and how I started to look at the market. And there's a lot of layers that are going to get over kind of that we're going to put on top of this over the next few weeks and months. But if you understand this phase, then you'll start to understand what's going on here. So just to give you again another example, I'm always using Asian session as my kind of reset for the day where I think price is going to consolidate. Manipulation is going to happen in London, and my distribution is going to happen in New York. And you see this kind of pattern played out over the Forex day, repeated over and over and over again. Just to give you guys another example, I'll look at a bearish example of this. So I'll go back to this same day. This is Monday, October 2nd. And we'll pull up the opposite day. On USD JPY. So again, I'm not sure if anybody's looked at the markets through this lens before. I know most people look at this, they immediately first start learning about support and resistance, and they start drawing lines in their charts. But you have to understand that this is a mechanism to take money, well, to trade money back and forth, right? And so we have to kind of look at how money moves, how the market moves on a regular basis. So most people will say the market is random. I had a finance professor back in college that said the same thing. The market doesn't have any rhyme or reason to it, but if you look at the players in the market, the big hedge funds, the big institutions, these same funds take money over and over and over and over again from, and they are, making money over and over day in and day out. And so if the market was truly random, then nobody would be able to have a sustained edge over time. So The fact that these corporations exist and these big hedge funds are making money year in and year out, um, means that there's something to it. So again, same thing here, but just the opposite example, right? This is going to be your classic buy day. So again, when we talk about the same thing that we just talked about, Asian session is going to be our consolidation phase where there's not a clear trend. Our manipulation phase is going to happen in London. Plus the start of distribution. And New York is going to be reserved for the rest of distribution. So when we think about this idea, again, plotting out the times, right? And this is something that if you guys are taking notes on this, I want you guys to have this written down on your notes. Asian session is going to start at 8 p.m. Eastern Standard Time. That is going to be, again, UTC4, and it's going to be about 2,000 hours on your clock. So from 20 to about 1 a.m. it's consolidation, right? How do we know this is consolidation? Because we can set a high and a low, and the market trades kind of in a range. Like it kind of just ranges, right? Up and down. Some days you'll see this market go up and down for more than that, but it's ranging back and forth. We know and what's happening during this time. Well, the market is building contracts up. Big funds, big institutions are placing money above and below in the form of buy stops and sell stops, right? So during this time, the market's just ranging, it's waiting, and it's kind of planning out the day, right? Just to kind of like keep things pretty simple. I can go way more in depth, but again, it's not going to help you trade better. So again, the market is waiting, and as the market is accumulating and consolidating, right? Consolidation or accumulation, right? During this time, market is building up contracts from big funds, big institutions. At the beginning of London session, which will be about 2 a.m. window. So mark this out. What will generally happen is price will manipulate. And what do I mean by manipulate? It will run down in a false trend against the overall trend or direction for the day. Now, this will not happen every single day, but it will happen more often than not. And if you go back in your charts, you'll see this play out over and over and over again. What will happen is the market will manipulate and grab all these buy stops or sell stops down here and triggering in those positions into the market, right? And again, we'll talk more about the idea of liquidity earlier at a later date, and it'll kind of make more sense there. But again, if you can start to see the pattern, then we'll lay the ideas of a liquidity over top of it. So at the beginning of London or in the London session, you should expect some type of manipulation, some type of false move against the overall trend. The later half of London going into New York session, you will 90% of the time see distribution. And this is an exercise that I have pretty much all my students do at some point in time, so they can understand this. Uh, Less with the idea of support and resistance, more with the idea of other things. So again, our Asian session is typically going to be used for the manipulation. I'm sorry, the consolidation or accumulation. What's going on during this time is that the market is accumulating contracts. It's moving back and forth, and um, there's no movement in the market. At 2 p.m., the market will use. I'm sorry, 2 a.m. from to 5 a.m. This will be our London session time, where the market will start to move against the overall direction for the day. And then from the rest of the day, from that end of London session into New York session, you'll see distribution. And so this is what the daily market looks like in the forex market. And usually it's going to be tied to these times. Now, I would say about 20 or 30% of the time, you'll see the market do kind of act out of character for this. But for the majority of the time, you'll see this same pattern play out day in and day out. If you go back on a weekly chart and look at Euro USD, USD JPY, whatever pair you want, look at it over that time, these times, and you'll see the market do the same thing over and over again. So I'll write these times down. Two to 5 a.m. for London Standard Time. And then New York session time is going to be, I'm just going to have the window that we're going to be looking at through the lens is going to be 7 to 10 a.m. But New York session will run obviously from about 9 to noon or 9 to 5. And obviously the market will slow down after about noon. Everybody who's trading Forex for more than a month knows that, right? So the session windows that you read online, like on a Baby Pips or whatever, or even the ones that we talked about last week, they're going to be the overarching windows, but these are the windows that I want you guys to look at for price action. 2 to 5 Eastern Standard Time for London, New York time, 7 to 10 a.m. This is usually when the market will start to turn around in reverse during these time windows. So what does this look like what does Power of 3 look like on a daily candle, right? So essentially, if you have a classic buy day, you'll see the candle look like this. We will start out with consolidation. So the candle will be flat. It will run down and make the low. The low of the day is here. Let's make this red so you can see this. And so this will be what the candle looks like pretty much during London session, right? You can see this low here. This will be a full bearish candle away from the high of the day, which will be somewhere around here. When that manipulation transitions into distribution, you'll obviously see this candle go up and it'll form, whatever the candle is for the day. Just make this green. Let's put this a long wick. It'll look something like this, right? If I were to go to the daily time frame on this, well, actually, it probably won't show up right because I'm on market replay. So I guess from a Power of 3 perspective, this is going to be like one of the main important lessons that I'm going to be teaching throughout the course of this, and we're going to layer things on top of this. I'm going to keep things very slow and very kind of like bite-sized as we go through this. But let me pause and see if there's any questions at all. Pause institutions. Boom. So going back to the questions in the comment section, Jameson says, I don't think the markets are random. I hear different things. Market makers, composite man, institutions. Right. So Jameson, we'll talk about them, but I totally subscribe to the idea of a market maker. Um, I know when you first hear these concepts, they seem very, very like, I don't know, like conspiracy theory-ish, right? But you can look up the market maker, and we'll talk about this more during the like that next week. But like you can look up companies that are market makers, like Ken Griffin at Citadel. If you are kind of like an interest in finance just outside of trading, you can Google people like Ken Griffin at Citadel. He is the largest market. His company is like the largest market making company in the world. Essentially, what a market maker does is they make they make the markets. So what they do is they take buy orders and sell orders and basically match them up. So like when we trade in our brokers, um, our orders are delivered through the broker into the market, and market makers are responsible for matching the orders with buyers and sellers. So it sounds very conspiracy theory ish, but my job here for you guys for this mentorship is really to take that conspiracy stuff and that like technical analysis and all that stuff and match it up to a point that it's a technical science, right? It's like the same thing happening over and over and over again, so you guys can clearly see what's going on and how the market works. So today will kind of be like the first lesson in like how the market how the market moves, um or why the market moves will be when we talk about next week or next couple weeks when we talk about market makers and why the market is moving and where the market is moving to will be kind of like the third lesson. So again, for today, we just have to understand the structure of the market, right? And you can see this play out in any on any pretty much any candle. You can see the power of three play out, right? So like if you were to look at the market through a uh, a 15-minute phase, an hourly phase. This is just the daily candle that I'm showing you guys here. But you can look at this, you can look at any candle and pretty much see power of three play out. So if I were to look at an hourly candle, right? Inevitably, what will happen with most candles, and you'll start to see this more and more the as you look at candles and price action, is what will happen is the market will set up, it'll have an initial range, it'll trade to a low, it'll trade to a high, and then it'll reverse back into the range. So what does this look like, right? On an actual candle. This is an hourly candle here, right? If you look here, we had an initial range. It's kind of white, so you might not be able to see it, but we have an initial range. We formed a low, which is this wick right there. We've made a high, and then we traded back into the range. It's power of three. So every single candle is going to be consolidation, manipulation, distribution, and then back into the range. What I'm showing you is pretty much the daily range and how the market moves on the daily. This is going to be one candle's worth of range. It forms an initial range, it forms a low, it forms a high, it trades back into the range. If you were to go to a 1 minute candle, right, on any time frame, this is a 1 minute time frame on USD JPY. I'm looking at a bullish candle. I like this one right here. It forms an initial range, it forms a low, it forms a high, and then it trades back into the range. Same thing here. Initial range, forms a low, forms a high, and trades back into the range. So power of three pretty much exists. Anytime you see candles moving, you will see power of three um, at work on any candle in any time frame, right? If we're bearish, we have an initial range, we form a high, we go low, leaving that wick, and then we trade back into the range. So this is pretty much how the market moves on a daily basis, right? That's how the market moves. What I'm showing you is the daily candle range. So if we go to the daily time frame on this same thing, you'll see the same thing play out. Uh, this is the current candle. It had a range. It formed a low, this huge wick. It formed a high, and then it traded back into the range, right? So if you understand power of three, it puts you in a really great position to understand how candles operate, how candles form, and then you can start to tie this into other concepts that we'll talk about. Because when we form a low and a high to a range, you might ask yourself, well, how do you know the market's going to turn around here and go here? Right? Or how do you know that the high and like what the high and the low are going to be? If you guys have ever watched me do those weekend calls, I can break down a lot of the time, not all the time, but I'd say like a good 70 to 80% of the time of what's going to happen on the weekly candles before they happen, right? And that's going to be using the concepts that we're going to talk about for the rest of this mentorship, like liquidity, like the market makers, like some other concepts as well. So this is all I want to cover for today. But the homework, right? So the homework we're gonna have for this week is I want everybody who watches this to pick a pair. Pick a Forex pair and do the same thing that I did, right? Over the course of a week, you're gonna have 5 candles. You don't have to watch it while it happens, like while you're trading. You can go back, this week and do last week, right? So you're gonna pick a Forex pair. And I want you to draw out your different sessions. So your Asian session, your London session, and your um, New York session, kind of using the times that I gave you. Again, Asian session is going to be 1 p.m. to 1 8 a. I'm sorry, 1 8 p.m. to 1 a.m. Eastern Standard Time. So I want you guys to draw a line at 8 p.m. and a line at 1 p.m. and look at the initial consolidation range. Oh, then I want you guys to do that same pair from London 2 to 5 Eastern Standard Time. I want you guys to draw that consolidation. I'm sorry, that manipulation, right? The same way I drew an arrow like this, kind of dictating that manipulation. Um, and then the beginning phase of the distribution. The same thing for New York session, right? I want you guys to draw those lines from, let's just say 7 a.m. to noon. Well, let's say 7 a.m. to 10, just to line it up. 7 a.m. to 10, right? And then I want you guys to have that distribution drawn out through. So like all these things. This kind of seems it's going to be a little bit unorthodox to what you've traditionally heard in day trading. I'm not going to work off these ideas of support and resistance lines or, for the most part, Fibonacci levels, that type of thing. It's going to be a little bit different. You're not going to hear me reference like engulfing candlesticks, all that stuff that you've heard in mentorships in the past. It's not going to be the thing. So this is what I want everybody to do. And if you're going to do this, again, pick a Forex pair. It could be USD JPY, it could be Euro USD. Let's stick with a major pair and draw out for a week straight, like last week's price action, or it could be, on Friday, you do this past week's, entire price action, but draw out your Asian session from 8 p.m. to 1 a.m., your London session from 2 to 5 a.m. Eastern Standard Time, and then your New York session again from 7 to 10 a.m. Obviously, New York is going to run till noon. We know that, but I just want you guys to get these windows kind of ingrained in you. And then draw out the different phases of the power of three. So consolidation, manipulation, and distribution. Again, if we go back to Euro USD, same thing. Just to give you the bearish example. Consolidation will be that high and that low. Manipulation and distribution, right? And if we were to look at this candle on a daily range, I guarantee you it would show you the same thing. It set a high, it traded up, and then it went low, it traded back into the range. So any tips in the indicator that also draws sessions? No, I don't want you to use that session Only because I just want you to get used to it. There's no like over time, if you want to use that like a year from now or a few months from now, don't worry about it. Like you can use that. But for now, I just want everybody to get used to those session times because one, because my session times are a little bit different than what TradingView might give you, right? So Asian session technically, just like we talked about last week, Asian session like technically runs from 8 p.m. to 3, I think, or something like that, or 2 o'clock. But these are the windows where the price reversals are going to happen, and that's why I want you to have these specific times instead of the ones that you might commonly see. Like even London session technically runs from 3 a.m. to noon, right? Not 2 to 5, like legally, right? Or I guess like officially is the time is 3:30 to noon. But usually during this time window is when the price reversals are going to happen. And so I want you guys to get used to using these specific times. So maybe over time you can use an indicator if there's one that kind of uses the same ones, but I would rather you guys just draw this out like this for now and get used to it. So this is where we're going to be for at least a week or so, just kind of understanding this power of three concept and watching it play out on a daily basis. I think if you can understand this alone, you can be a profitable trader. Um, well, I take it back. I don't know if you can be a profitable trader because you're gonna need more than just the you're gonna need the mental aspects of trading, but you can be a great analyst in where you think the market price is gonna go. Um, if you just understand power of three on the daily. So this is what I want you guys to go back and do. Pick a pair, Euro USD. If you're in this mentorship and you're not one of my mentorship students, like my private mentorship students, um, you can just message me, find me in the Telegram chat. If you're in the Telegram, if you're not in the Telegram, find me on social media and message me, and I'll give you the link to the Telegram chat. If you are in the Telegram chat, or if you are a mentorship student already, just use the Telegram chat to give me some examples, and I'll talk about them, and I'll probably pull a couple up from like from what people send me, and we can talk about them. But yeah, so using this. So again, consolidation, manipulation, and then distribution. So this will be the only thing that I want you guys to focus on for this week, and we'll come back next Sunday. Actually, we probably will not be meeting next Sunday. I'll be out of town next Sunday, so we probably won't be meeting next Sunday. But this is what I want you guys to focus on for the next week or two, and ingrain this into your heads. I know it seems like a very simple idea, but these markets are not these markets are very simple when you understand like what the purpose of them is and what they're supposed to be doing. Trading is not hard. Trading is just, I think a lot of times people have been fed bad information or the wrong information, and they're relying on a lot of things they don't need. So um again, my goal here is to demystify the markets for y'all and make sure that you guys can understand exactly what's going on, what's truthfully going on in the markets when you trade. So I'll stay on for any questions. I know my camera hasn't been on the whole time, but I'll stay on for a couple of questions for the next few minutes. If you guys have any questions at all about this, then let me know. But this is going to be, bite-sized mentorship. It's going to be free. Obviously, it's going to be very slow. So I want you guys to get this, and I don't want to rush it. If you're trading with the way that I trade, and it's your first time seeing this, you're not going to be in the markets trading live this year. This is going to be a rest of the year resetting and refocusing. So I'll stay on for any questions. If you guys have those. But yeah, this is all I want you to focus on for this week. I'll drop the little screenshot of Power of Three in the chat, and we can go from there. Main differences between indices and Forex. Forex is actually, to me, I think just again, having this concept purely cemented is one of the reasons why I think Forex is easier to trade, but the main difference is just the volatility. Like, I think a lot of people are coming into the markets now, um, and they are trading indices and they don't really have a good background in trading. And you can lose a lot of money trading indices very quickly if you don't know what you're doing. Like a lot of money, like an exuberant amount of money, like quick, man. So I want to make sure that everybody kind of has the foundations. Another difference to Forex is really just going to be the times that you're going to trade. Obviously, London session is more prevalent in Forex. When you're trading indices, it's going to be New York based, and obviously most of the volatility, even in Forex, is going to happen in New York. But I would say you have more opportunities to trade in Forex than you do so if your time window does not line up with like the current like 9 to 5 window that you would probably need to be able to trade indices, there's a London session in Forex that you can primarily trade. So there's that. I would say, yeah, volatility is probably more in indices. So these charts don't move as quickly as the Forex ones or as the indices ones. But again, to me, I don't really care about volatility and quickness as much as I care about being able to project what the markets are going to do. Because if you can project what the markets are going to do, if they're moving fast or moving slow, you're still going to make money, right? And so that's the most important thing. Um, I would say indices, depending on where you live. So this is another good question too. So depending on where you live, uh, forex, I'm sorry, indices might be banned from where you're at. So you might have to trade like a forex equivalent to an indices. Like you might see people say trade Nas 100 versus um, Nas 100 versus like NQ, which is what I trade. So if you don't live in the United States, you can't trade indices, or at least you can't trade the ones that most people trade. I think every country has their own indices. Like if you live in Japan, you can't trade Nasdaq, but you could trade like Japan 225 or something like that, which is the Japanese version of that. So every country I think has their own indices that they can trade or index they can trade. But if you don't live in the United States, you can't trade the big ones. So like the ones that I do on the call, you would have to use like a forex broker to trade those. But those are like the main differences: volatility, times where you can trade, that type of thing. So again, uh, any questions? I'm cool. Feel free to answer. Big facts, coach. Appreciate it, Tony. So yeah, so I'll end the call here. If you guys have any questions, just hit me on Telegram. I don't know if this will be a big mentorship. I might be opening myself up to a lot, but uh, ideally, I would love if some people sent me some screenshots of the power of three so we can talk about this next week. Appreciate it. Peace.